When Olive Garden is shrinking pasta, you know it's a massive warning to the U.S. economy. I'm going to show you why restaurants are getting increasingly desperate, how shrinkflation is sneaking into your wallet, and what this ultimately means for jobs, inflation, and your next night out. Stick around because while portion sizes are getting smaller, the economic problems, they're getting bigger and fast. Let's take a look because Olive Garden has now rolled out smaller portion, lower price entrees at select Olive Garden locations during this last quarter. This is all part of its test and strategy to make its menus more affordable and boost sales. This from Chief Executive Rick Cardenas. And let's talk about the media's view here because they've got a completely skewed view of what's really going on in the real economy. The shift reflects broader changes in dining habits as millions of Americans are now taking weight loss drugs that control appetites and consumers are more broadly cutting back on dining out to save money. And you know, I don't think it has anything to do with weight loss drugs because I know plenty of people that are trying to lose weight and yet they still eat out. But this isn't about Americans saving money because the real issue here is Americans can no longer afford to eat out. You know, we've been talking about this for years, have wages have been slipping behind and not keeping up with inflation. And finally, we're starting to see real economic effects because when Americans cut eating out, well, you know things are bad. Let's take a look at this recent survey by technology firm Lightspeed Commerce. It was published back in August, and they found that 44% of U.S. adults are ordering from kids' menus, citing lower prices, smaller portions, and simpler options. In the end of the day, it doesn't matter what restaurants do. Demand is dropping here and in a big way. Consumers still want to eat out. The problem is they can't afford it. Let's take a look at their earnings because growth from existing locations at its key Olive Garden and Longhorn chain slowed from last quarter, and they already are projecting it's going to get worse. So what you're hearing from Darden are saying, look, we think demand is going to get a whole lot worse here. Now, when that happens, competition starts to increase. Now, you see mistakes being made like companies like Cracker Barrel who thinks, well, we need to rebrand, and well, we can all know how well that went over. But ultimately, it comes down to price and the value that consumers think they're getting from the dollar. But the issue for the restaurant space, well, it's about to get a whole lot worse because prices are going up in a big way. Let's take a look because surging beef prices as an example, specifically hamburger meat on the wholesale level. Back in July, those prices were up nearly 21% compared with the same month 10 years ago, according to federal data. And passing the buck to customers might not be the best solution. But the problem is beef prices have gone up again and in a big way. Now, recently I was talking to a local manager of a steakhouse and she says, look, Steve, you have no idea how we're getting impacted. You don't know that beef prices went up a whole lot here, and the problem we're facing is we can't raise prices. And I asked her, I said, what do you mean you can't raise prices? She goes, we've reached our limit. Now look, she goes, we're going to have to raise prices a couple bucks where we can, but the reality is we already know if we raise prices anymore, fewer people are going to come. We can't afford to do that. So she says, look, we're making changes. I'm telling my staff, we need to be competitive. We need to increase our quality. We need to increase our service. We need to take market share. We need to increase our volume because we can't pass these prices on. And again, that's why you're going to see this huge focus on volume all of a sudden. And that means restaurants are going to try everything. They're going to rebrand. They're going to cut prices. They're going to cut portion sizes. They're going to offer promotions. They're going to do anything they can to get you in the door because the bottom line is it's all about paychecks. Let's take a look at this chart of the consumer price index against average weekly hours of production and non-supervisory employees, and we can see this relationship going into every recession. Let's go back to the late 1980s. What happens? Average weekly hours in red are falling, inflation is rising, and consumers have to make a sacrifice. You see the same thing happen going to the dot-com bubble, the financial crisis. Let's take a look at where we're at now because since 2023, paychecks have largely been stagnant as hours worked have bottomed out, but yet inflation continues to run at an aggressive level relative to paychecks. But one thing that shouldn't be shrinking alongside portion sizes, and that's your trading account. Let's take a look at this trade we put on DAPP back on the 10th to all of our subscribers, now up 16.52%. My friends, this comes right from our optimized meta strategy, and right now we are changing the game when it comes to the way people trade. I have optimized every security on a per security basis and combined it into a complete meta strategy. Now, to get in on this trade and other trades like it, all you have to do is grab those links in the description description below. And be sure to use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. So again, we go back and look at the real issue here that are facing American consumers, and there's a reason why. This Pop Menu survey said 67% of American consumers said they're reducing their spending on everything from food to clothes and travel. The real issue here is it's about inflation, wages, and the jobs market. And we know that relative to inflation, wages are shrinking, and the jobs market, well, we're on the cusp. If things continue to turn down, we're going to see mass unemployment. This is exactly what we're seeing in the consumer surveys. Because when we dig deeper into the retail space, let's take a look at this next chart of retail sales versus continued claims. And I want you to see, as consumers pull back on eating out, it affects a lot of people's wages. And here you can see as retail sales drop, as we can look back, going in the dot-com bubble, here see very clearly in blue what happens. Continued claims rise. If we continue to see Americans talk about cutting back, the labor market, my friends, is next to go. And that's the real risk here, because when you start to see companies like Olive Garden start to cut their portion sizes, again, that's why I said it's a major warning to the U.S. economy, because it's not about the portion size, it's about the consumer. Now, Pop Menu co-founder and chief executive officer Brendan Sweeney said in a statement, quote, "Restaurants don't only have to compete harder with one another," which is exactly what my friend said she's going to have to do at her restaurant. They have to compete with every other business out there trying to get a bigger share of consumer spend. Continually engaging customers across digital channels and providing financial incentives to dine with you are now more critical than ever. And again, these are the real issues facing a lot of businesses, because if they don't get the number of customers they need, if they can't hit their margins, the risk is they're going to have to cut hours, they're going to have to lay people off, and in some cases, you're going to start to see entire restaurants shut down as business looks to consolidate and get rid of their underperforming stores. This is a major crisis that's just beginning. And these personal budget cuts come as 75% of U.S. consumers say they're concerned about the United States dipping into recession this year. However, not to worry, because back in May, J.P. Morgan research reduced the probability of U.S. and global recession occurring in 2025 from 60 to 40%. So that's great news from J.P. Morgan to say not to worry, we're not heading into a recession. But that's not what consumers are seeing here, and that's not the behavior we're seeing, because as consumers cut back in a consumption-led economy, it means we are headed into a recession. Let's take a look at this next chart of the University of Michigan Consumer Sentiment Survey, that's shown in blue, and it's average weekly hours of production and non-supervisory employees, because I think JP Morgan's research here is completely off base, and what we're hearing in the consumer sentiment surveys is spot on. Let's take a look, because you can see very clearly the University of Michigan survey in blue going down. And why is it going down? Because weekly hours are dropping. And you can see weekly hours lead confidence every time. But you'll note when the two are going down together, what happens? Well, we head into a recession. And that was a big red flag. We saw this drop in consumer confidence at the last report, because what it was suggesting and what I was concerned about is that it was indicating that we're about to see a big drop in hours. And now we're seeing Americans cut back on eating out and saying, look, you've got to give us smaller portion sizes and smaller prices, and everybody's starting to scramble. And this change is showing up in restaurant sales. Between January and March, Americans ate 1 billion fewer restaurant meals than during the same period last year, according to Circana. And again, you talk about the backfeed this is going to have in the economy. It's going to lead to fewer jobs. You're going to see hours get cut. You're going to see restaurants close. And again, if you start to look at the real issue here, is the restaurants don't know how to handle this. Let's take a look, because Chipotle CEO Scott Boatwright pointed directly to the rise of low-cost competitors. You have to look no further than what's going on with our competitors with snack occasions or $5 meals. That's where the consumer is drifting towards. And that's because the consumers don't have the money they used to. And this is a reality that a lot of businesses are waking up to, that demand that they were hoping was going to come back in the second half of this year isn't there, because paychecks haven't kept pace with what's going on in the real economy. And the problem here is when one business starts to lower prices and starts to see success, what's going to happen? Other businesses are going to follow. And that's how we end up in a recession. That's how we get to disinflation and deflation. And I want you to think about all the tip staff out there. As portion sizes and checks decrease, well, their tips are going to go down too. And ultimately, we're going to see restaurants fail here. And tightening the belt on restaurant spending is one of the earliest signs of households are feeling economic strain. This from Todd Belt, the professor at George Washington University. It's not just about skipping the night out, it's about families making daily trade-offs. And again, this is what I've been warning about for years, that this day was coming, where paychecks were finally going to get to the point where people could not afford their daily spending, and they're going to have to cut back on the discretionary side of the economy. And the first place you start to see it is at restaurants and bars, and now that's happening as you see companies like Olive Garden start to scramble. And as we look at other leading indicators in terms of new orders, backlogs, and eating out, there are clear signs, just like Olive Garden is shrinking portion sizes, that the U.S. economy right now is shrinking as well, my friends. When companies like Olive Garden can't sell pasta and subprime lenders unexpectedly file bankruptcy, you know things are bad. Problem is, they're about to get a whole lot worse. Now, if you're looking to make money in the markets, let me show you my optimized Metre strategy, because it's changing the game when the way people trade. Let's take a look at that trade on DAPP, again up 16.52%, and that one on the books as of the 10th. Now, let's take a look, because I want you to see this Metre strategy. Now, this is a 3-year back test, and I want you to see it beat buy and hold by 13.44%. That's impressive. That's unheard of. But how about this? It generated 69 trades with a 66% win rate. Again, unheard of, with a max drawdown of just over 7%. Now, let me show you this compared to an unoptimized strategy, because what I've done with the Metre strategy is on a per security basis, I've optimized every underlying strategy. Now, when you compare it to something that's unoptimized, well, you get a far worse results. Let's take a look at the Bravo 9. Now, this is something run by my buddy Jay Bravo that says you can't even just run this on its own. You need a whole lot of other signals to go with it, but not with mine. Look at the total return, 51% missing a buy and hold strategy, generating half the number of trades, and look at the win rate, a paltry 51%, and you're generating the same drawdown. Now, what is my Metre strategy? It's an advanced trading system that combines 9 strategies into a single intelligent signal generator, each optimized on a per security basis. And we're getting ready to make a major update to this, because right now it's optimized on a 10-day hold to get you the biggest potential return as a swing trade. Again, we're changing the game here. Now, how do you get these trades? Well, you got to sign up for one of my reports. Now, maybe you like trading against machine positioning. That's called our CTA Timer Pro. Maybe you like trading momentum signals, and we call that our Momentum Timer Pro report. Now, either way, you've got to sign up for one of my reports, and you get all of the signals from that report, plus those Metre strategy trades. In addition, you get my opinion on the best trades, risk control levels, a full tracking of all our open trades and returns, a weekly update, and here's the best part. You don't even have to put a dime out to try reports. You don't have to put a dime out if you're comparing this to other strategies, because we have a 30-day free trial. All you got to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.